Well, how do you get a 3% interest rate in 2023? Subject to financing. My name is Steve Peterson and welcome to our channel. We talk all things commercial investment, real estate. In today's video, we're gonna be talking about the impact, the ROI driven impact of subject to financing. All right, and this is in the creative financing world that we are now entering into due to, 7-8%, high 6% interest rates that we're seeing on investment properties. And the cheapest, multifamily rate that I've seen is it's November now, 2023. I'm looking at like high sixes, 6% on apartment loans, but most of the, rates that I've seen are in the sevens. I've even seen them in the eights. I don't know how you make money on apartment buildings with an 8% interest rate. Even if you're buying in the South, in the Midwest, where those markets have really taken off. So, how do you make money, right? Subject to, right? Subject to taking over somebody's mortgage, buying somebody's property, subject to the existing mortgage can make you a lot of money. That's because in the last few years, we've had very low interest rates. And I've got a few deals I'm working on right now where you could take over the loans 3.1%, 3.875%, 4%. Now, you got to put cash down. And you might be able to get the seller to carry something beyond that. But this is a great way for you to make money on investment properties in 2023. So let me break down 3 elements of subject to financing. All right, number 1. First of all, when you do a deal like this, the deed does transfer. This is not a lease with option to buy. This is not an installment sale. The actual at close of escrow, the deed will transfer over to the buyer. This all gets done through escrow, by the way. This is not some backdoor, you write on a piece of paper and we get the deal done, a quick claim deed. No. It happens through escrow. This is legal, right? The first element of it essentially is it is not approved by the bank. This is not a formal assumption of the loan. Now, obviously, I'll do another video where we talk about formal assumptions and also where we talk about wraparound mortgages. This video is about subject to financing. So the first thing here is that the deed does transfer, all right, and it does go through title. Now, some title companies may or may not do it, but I actually know a lot of them that I work with, the top companies will insure the title. So at close of escrow, the buyer gets the full, clean title on the property. Now, the lender does not approve this though, right? So this is kind of 2 points in one, is that you get title, but the lender does not approve it. They don't know about it. This is done between the buyer and the seller. What does that mean? That means that the seller is still on the hook for that mortgage, meaning that it's in their name, reports in their, depending on how they got it set up, if it's through an LLC or whatever, it's not going to be in their personal credit, but it does report and it does affect their personal credit. And if, let's say, the buyer cannot come through, cannot make the mortgage payments, then that seller could be, has risk of foreclosure. So that's a big risk. The seller's got to be willing to take that risk, right? But, the deed transfers to the buyer, but the loan is in the seller's name, all right? So that's the first thing to know about subject to, right? The second thing we got to take under consideration is the mortgage balance. What is the mortgage balance, right? Because on title, what's filed on title is the deed of trust. That's going to be the original loan amount. But the balance, depending on if it's an interest-only loan, an amortized loan, will have been paid down over the years. So you need to make sure you understand what the balance of that mortgage is. Now, the way to properly do that is to have the buyer or the seller provide you with a current mortgage statement with the balance on it, right? So that you know what that balance is. It's very important because a lot of people mix this up. It's the lien and the balance are two different things, because unless it's interest only, the principal balance has been paid down. So you have to understand what that balance of that mortgage is. Say the property you're buying is $1 million. Say the deed of trust originally was $700,000, but now it's been paid down. The balance is $600,000. So that would mean that you would need to come in with $400,000 to close it out. That's really, really critically important when you're doing your research, to make sure you understand what the current mortgage balance is and you plan accordingly. The last piece is, as we're talking about subject to, is the potential for having the seller carry over and beyond, maybe them carrying an actual promissory note and deed of trust in second position, or being prepared to come in with the entire down payment. The thing about subject to financing is that the down payment might be a little bit more than if you were to go to get new financing today, but the interest rate's gonna be a whole lot better, right? The interest rate's gonna be a whole lot better. So that's why you would do that. Hey, if you got money and you're looking at the returns and you say, hey, I'll be willing to put a little bit more money down if I can get that rate because my ROI is gonna be boosted versus, significantly boosted versus if I went and got a market rate of interest, right? These are some creative ways to make deals work, all right? Is there risk involved? Yes, there's risk involved. Most loans, most commercial loans, probably 99.999% of them have what's called a due on sale clause, meaning that when the property is sold, the loan is due on sale. So the risk there is if you take over somebody's mortgage subject to is the bank gets wind of it, they could call the mortgage, right? They could call it, meaning that, hey, you got to pay them off, all right? And then that's, and if you don't pay them off, you risk losing the property. But probably more than losing the property, probably the real risk is you would have to refinance and put market rate financing on it, which is the whole reason you purchased the property subject to. So that risk needs to be understood, that risk needs to be mitigated, that risk needs to be discussed up front. And if you're sophisticated enough to take that on, you can make it work. I always like to, full disclosure on these videos to say, hey, these are the pros and the cons. I think if you can get a sweet enough to, hey, look, 3.1%, 3.87%, if you know what you're doing, it's worth that risk, all right? And it's a way you can get deals closed. Because right now, we got to get creative out here. We have to get creative. We got to think outside the box, subject to financing. That might help you close your next deal. Let me know your thoughts. Give me your feedback. To the next video. Peace.